With rising debt levels across Europe, are we reaching a debt crisis? In cities like London, Paris, and Amsterdam, debt has become a major issue for young people and families alike. Household debt in Europe varies widely. In Scandinavia, households carry some of the highest debt-to-income ratios worldwide, with Denmark's ratio at over 250%. Across the EU, over 30% of households report having significant financial difficulties, especially in countries with high cost of living and low wage growth. Today we will explore the root causes of debt, cultural influences, government policies, and practical solutions. We will focus on understanding the importance of debt to achieve financial freedom. Thank you guys so much for clicking on this week's video. Please don't forget to like, subscribe, and let's get started. A brief history of debt in Europe. Post-war economic boom. After World War II, many European countries went through an economic boom, encouraging borrowing and spending as credit became more accessible. However, this culture of credit expanded significantly in recent decades. Credit cards in the 1980s and 1990s. The rise of credit cards in the UK and Western Europe introduced a new way to borrow, leading to a new culture of buy now and pay later that still influences spending habits today. Impact of the 2018 financial crisis. Many households and individuals faced job losses and lost savings with stagnating wages. Debt levels continued to grow. Countries like Spain, Ireland, and Greece were heavily affected, and the crisis led to austerity measures in many of the EU countries, which still affect spending and saving power today. Wage stagnation and rising cost of living. Despite recent growth in many European economies, wages haven't kept pace with inflation. For example, in the UK, real wage growth has been close to zero for years, meaning that buying power has barely increased. Housing crisis in major cities. Cities such as Amsterdam, Paris, and Dublin are facing significant housing shortages. In Amsterdam, rent prices have doubled in the last decade. And in Dublin, rent hikes are so common that many young professionals consider moving abroad. The cost of essentials is also going up. In Oslo and Stockholm, groceries and utilities are among the highest in Europe, and families can easily spend 400 to 600 per month on groceries. Meanwhile, in Mediterranean countries, essentials are more affordable. Youth unemployment remains high, limiting the ability of many young people to achieve financial independence. Impact on debt levels. These factors forces many to rely on credit cards to pay their monthly expenses. British students now carry on an average of £40,000 in student debt due to high tuition fees. With interest rates sometimes reaching over 6%, many graduates struggle to pay down their debts. The impact of these repayments on those loans can seem like an invisible tax on the income, affecting the ability of young people to save and invest. Another example is the Dutch student debt. In the Netherlands, students graduate with an average debt of €15,000. Housing costs in cities like Amsterdam mean many students continue borrowing after university to meet rent and daily expenses. The Dutch government has also changed its loan system to encourage more repayment, adding pressure on recent graduates who are starting their careers with low entry salaries. Impact on the long-term financial goals. Many young Europeans delay milestones, such as buying a home or starting a family, or saving for retirement, often taking on even more debt to manage these life goals. The allure and danger of easy credit cards. Services such as Klarna and Afterpay are extremely popular in big cities such as London, Berlin, and Paris, where consumers can defer payments for purchases without upfront cost. However, missing payments leads them to penalty, fees, and extra interest, trapping people into debt. Cultural pressure and financial literacy. In fashion hubs like Milan and Paris, influencers and luxury brands promote high-end products, encouraging a buy now and worry later attitude. This pressure is particularly intense in countries such as Italy and France, when style and social status are closely linked. Despite the rising debt, financial literacy education is rare in many European countries, In Spain, for example, only a small percentage of schools offer personal finance courses, leaving many to learn budgeting and debt management on their own. According to a 2018 study by the European Central Bank, only 50% of Europeans understand financial concepts, contributing to poor money management and rising debt. Government policies and debt regulation. In Nordic countries, there are debt reliefs and programs for those struggling with repayments. For example, in Sweden, a program allows borrowers to negotiate their debt repayments based on income level. Caps on interest rates in some countries. The UK has regulation on capping interest rates on payday loans in order to protect consumers and borrowers. Recent EU directives on financial education. The EU has recommended that member states incorporate financial education into school curriculums. Though progress is slow, countries like the Netherlands and France are starting to introduce more financial courses, which may help prevent future generations from falling into debt. Practical strategies to manage and reduce debt. Number 1 is the snowball method. Focus on paying the smallest debt first. For example, if a person has 500 euros and 1,500 euros in debt, they should focus on repaying the 500 euros in debt to build motivation. Number 2 is the avalanche method. Prioritize high interest debt. If a viewer has a credit card with a 20% interest rate and a student loan at 5%, paying off the credit card first reduces the overall interest cost. Number 3 is creating a monthly budget. I encourage you to use a budgeting app such as Revolut. Categorizing expenses can help people see where they overspend and cut back on unnecessary expenses. Having an emergency fund is a key pillar to your financial success. Having at least 3 to 6 months of expenses, making you avoid credit cards in case of emergencies. High cost of living, student debt, and easy access to credit cards, and especially cultural pressure, they all contribute to Europe's rising debt levels. But by understanding these issues and taking small and steady steps, anyone can work towards financial freedom. Please share your experiences with debt and financial tips in the comments down below.